right?
I think so. Hi, it's Marty Remo Remax, and I'm here with Ali Chamois, who I've worked with for the better part of my career, which I'm not even going to say how long that has been, but thank you for doing this. I know this is a stretch, and I really appreciate it.
No problem, Marty. It's good working with you. It's been way too many years, but it's all good. At least we're still here.
I know, going back to the Century 21 Gold Door days. Go figure.
I know, absolutely.
I mean, it feels like a world away, but it really was. Really, what I want to talk to you about, because you're such an expert regarding the mortgage situations, and like what I'm dealing with on my end are buyers that are getting into these bidding wars, or I'm dealing with buyers that are, everything seems to be competitive in terms of people in houses, especially first-time home buyers. So, I guess my first question would be, like, how would a first-time home buyer prepare themselves to put themselves in the best position to buy a house these days?
Okay, there's actually I'm going to say there's three things that come to mind right away. One is the most obvious, is your credit. You want to get your credit in order. You want to have a good credit score. That's number one. The second thing is go to a lender, go to your bank, go to a mortgage officer, a mortgage company, a loan officer, somebody like myself, and you want to do something called a pre-approval. Okay, there's two things that you can do when you talk to your lender. You can do something called a pre-qualification, or you can take it a little bit a step further than that and do something called a pre-approval. Now, there's a distinct difference between the two. A pre-qualification is when I talk to a client, they give me their basic information, I run their credit, I run their numbers, and I determine that they're qualified to buy a house, okay? And I issue them a pre-qualification letter. Right. A pre-approval letter, not only do we run their credit and I collect documentation, but I create a file, a mortgage application file with a property to be determined, and their file goes to an underwriter. An underwriter is the person that makes the loan decision for a mortgage commitment, okay, subject to finding a property. And the reason why that's so much stronger is really because by law, a commissioned loan officer cannot really do a pre-approval. I cannot do a pre-approval. I'm not legally allowed to do that. So you want to get a pre-approval because that means your file is going to the person that ultimately approves your loan. So if you have a pre-approval, that means you have a commitment to buy a house.
Awesome. So like if two people are making the same offer, the same dollar amount, and one person has a pre-qualification and one person has a pre-approval, the pre-approval would beat their pre-qualification.
Absolutely, because that file's gone to an underwriter. It's a done deal. In other words, there's no hidden things. There's nothing could be revealed because everything has gotten treated like a regular mortgage application, as though you were buying a house. It's the same exact thing, except you don't have a property yet.
So like,
it's definitely stronger.
If I got pre-approved, like how long, like do I have to pay? What do I have to pay? Do I pay an application fee? How long does this pre-approval last for? Do I have to buy within a certain period of time, or?
Okay, our pre-approvals are free. Okay, we do them for free. We run a full-blown credit report, which costs us a few dollars, but we do not charge the customer on a pre-approval. They'll pay it when they get to the closing table. And for the most part, it's good for 90 days. Now, the expiration date varies depending on the type of loan it is, conventional, FHA, and that's only because the credit report would expire. Okay, right. So I would go with a benchmark of roughly 90 days.
90 days. Okay, so if you're going to buy, you think you're going to make a decision within the next 90 days, your first step should be to call you and get pre-approved, so that you're in a better position to make an offer when you do find the property, right?
Absolutely.
So, okay.
Absolutely. Yeah.
So like, there's different types of mortgages. People hear there's conventional mortgages, 5% down conventionals. There's FHAs, which are what, 3.5% down?
3.5% down, yeah.
And that is probably more typical. Like, what kind of credit scores do you need in order to qualify for each of these loans?
Well, conventional is a little bit stricter with the credit scores, not so much in the fact that we won't approve your loan, but you're going to see a tremendous difference in the interest rates. And I knew we were going to have this call today, so I did a little research. So I'm just going to give you a simple example on a purchase. Okay, let's say you're buying a house for $300,000 and you're putting 5% down. Okay, so, and there's a lot of scores in between this, but I did a credit score of 760. Okay, $300,000 purchase price, 5% down. A credit score of 760. Today's rate would be 2.75 with 0 points. Okay,
Wow.
I ran that same scenario with a 680 credit score, and the interest rate is 3.5% with 0 points. So that's 0.75% higher on a 680 credit score.
Right.
Okay. In addition to that, I didn't run numbers on this because I really need a file to be able to do it. But your PMI, which is private mortgage insurance, is also substantially higher if you have a lower credit score. Substantially higher. Yeah.
Right. So, like, what would the minimum credit score be on a FHA loan and on a conventional? Like, what?
The minimum credit score on FHA is 620. I know there's lenders out there that will go to 580, but we're at a 620. Conventional, probably 620, but I typically won't write it. I'll convert it to an FHA loan because your rate and PMI would be so high. It actually wouldn't even make sense to do a conventional loan on a 620 credit score. It seriously wouldn't make sense.
So what we're dealing with on our end is it's competitive. So you said like that $300,000 example is perfect. We'll get a $300,000 house that goes on the market, and the first day or two we have 5 offers on that property.
Yep.
A lot of times they're going over the asking price, which can create a problem with somebody that doesn't have a substantial down payment. Like my view on it is usually the conventional mortgage would, if all bets were even, the conventional mortgage would be a better offer than the FHA mortgage, or is that not the case?
You mean on if you want to go over the price?
Yeah, let's say that $300,000 house sells for $310,000.
Okay.
So what would be required? Let's say that it appraises at the $300,000, meaning the bank feels that it's worth $300,000, yet the market's saying it's worth $310,000. The buyer would have to potentially come up with an additional $10,000 plus on an FHA plus the 3.5% or plus the 5%. So that's
right. You're right. They'd have to come up with the extra money. So on a conventional, it would be a little bit easier because typically an FHA borrower isn't going to have that extra money.
Right. And what we're seeing a lot of here with the FHA, because we're dealing with a lot of people from the city. I mean, everybody with COVID is, running out of the city to buy up here, and everybody up here seems to be going down south or Tennessee or Delaware or wherever they don't charge any taxes where they're going.
Right.
So like what we're dealing with too is a lot of times people aren't using the local mortgage people that understand what the local deal is here. And I'm getting FHA pre-approvals for $500,000, and that's not something that will work in Orange County, New York, right? So
yes. Last year, the FHA lowered the loan limit in Orange County. They only lowered it, I think, in 2 or 3 counties across the country, but they lowered it in Orange County to 356.5. So yes, if you get a pre-qualification for a property in Orange County for $400,000, it doesn't mean anything because FHA is limiting that to 356.5. Stay tuned for that new amount going into 2021. We just got the amounts for conventional. We did not receive the loan amounts yet quite for FHA for Orange County, but they'll be out soon.
Do you think they'll be higher or lower?
Last year was a shock that they lowered them in Orange County. So I can't even say what to expect because last year was a total shock. We were completely shocked and blindsided by the fact that they went down. So, and I got a lot of calls on it from realtors too. Is this a mistake? and it wasn't a mistake. It was very, very strange that happened. So I'm not sure what to expect.
Yeah, when I saw that, you know, a pre-approval with 500,000 with an FHA loan, you know, my first thought on that was, okay, you know, they're to come up, you come up with the difference between the 350 and change and 500, and if people can do that, then they must have some pretty bad credit, I would imagine.
Yeah, it does. That barely even makes sense. I mean, you're right. They must
Right.
have really bad credit and a lot of money. And honestly, that almost doesn't even make sense.
Right. And I think too, like in the multiple offer situation, you know, it's, yeah, who's pre-approved, who's versus who's pre-qualified or who's got nothing at all. And then a local mortgage person, it holds a lot of weight. It really does, because if it's some bank, you know, .com that
Yes.
we've never heard of,
Yes.
it's not a lot. The real estate people don't have a lot of faith in it, and the seller certainly doesn't have any faith in that too.
Right. Right.
But when you do see, because you're banking on, like I'm banking on working with other real estate agents that believe in what I'm putting forward, and if I'm putting it forward with a reputable mortgage person that
Yes.
they've worked with over and over and over again, it's easier to win. I mean, you know, lack of being able to say it any other way. So I think there's definitely a value in getting pre-approved with a local person that has the experience, and then Homestead too. You guys have like pretty much every program under the sun. You know, I mean,
Yes.
it's not,
And not at all. This is not a bragging thing at all. But this is exactly what you're talking about. This scenario that happened to me about 6 months ago. I had the buyer. The listing agent, the buyer was working with a company, as you said, maybe down in Staten Island or Brooklyn or Queens, of a lender that no one up here knew of. So my buyer made an offer with a pre-qual from some crazy company. The listing agent demanded that they get a pre-qual from a local agent. The realtor that I was working with, referred this buyer to me. I did the pre-qualification letter. The listing agent was thrilled that it was Homestead and it was local, and they got an accepted offer. Because the listing agent was very familiar with Homestead and that we're all local. Absolutely.
It's so true. Even some of these big banks that people think, oh, well, this is, you know, I won't even say it, but like, this is this bank, and we cringe. We're like,
Yes.
oh, no, not that one that starts with a C, you know, or
Yes.
whatever, you know. So
Exactly.
I mean, there's definitely an advantage. So I mean, to me, in this market too, you know, I'm not dying to go out with people that are not. They need to show the first level of commitment. If they're
They do.
you know, if they're unwilling to go speak with a mortgage professional, get a pre-approval,
Yes.
you know, it shows that they're committed. Therefore, I'll commit my time and energy to make it happen, you know, the best I can for you. So, you know, no, but I mean, thanks so much. Anything else that we can do? Anything else that you can add in terms of just positioning?
There's one other thing that comes up now in today's market, because let's say pre-COVID, before COVID, this was not a problem. Okay. Now, because of the mass volumes of people wanting to buy in Orange County, seller concessions are not looked upon real favorably anymore, because if you have 5 offers, if you're a seller, you have 5 offers, 2 of those offers have a seller concession, 3 of those offers do not. They're going to pick the ones without a seller concession, because as you know, when you have a seller concession, the house probably has to appraise higher than, you know, what it's listed for. So seller concession is not good right now.
It's basically when the seller gives you X amount of dollars towards closing costs or towards repair work or whatever it might be.
Correct.
Usually it's towards closing costs, because people have the down payment but may not have enough to get through the closing. So in a sense, they're financing it, but then the property needs to appraise out for more money than what that seller is actually getting, even if it's over the listing price, which is, it's typically very hard to get properties to appraise for more money than what you're asking for the house.
Correct.
Not
Correct.
that it doesn't happen. It happened to me yesterday, and I don't know how that happened. But that's the other thing too. Like when these appraisers come out here, I don't know if they're coming from Port Jervis or from Westchester. So like
Right.
what they're bringing to the table in terms of what's in their mind in terms of value. So it's interesting out there, but I think it's definitely worthwhile to speak to a lender like Ali and locally and get the pre-approval. It's not something that you'll regret. And I think that just understanding, even the players, even the attorneys that we work with over and over again, title companies, stuff like that. There's something to be said about, even though we're on the internet, is personal relationships with these people.
Absolutely.
I mean,
Yeah.
it just, you cut through a lot of the red tape and make the process a lot easier.
Exactly. Exactly.
But thanks so much for doing this.
Thank you for having me. Thanks for having me.
And I'll be in touch with you real soon.
Okay. Thanks, Marty. Have a happy Thanksgiving.
Oh, you too.
Okay. Thanks. Bye-bye.